What is up, trading family? It's your boy Wildcard, and today we're staring down a market that is literally telling two completely different stories at the exact same time. The KOSP. I just detonated 10.84%. Circuit breakers went off like firecrackers, and the VIX is sitting at 18.86, like nothing happened. TB, hit him with the disclaimer before the tape twists any heads.
Quick reminder, nothing we say is financial advice. We're two traders talking markets, not telling anyone what to buy. Do your own homework. Core durable goods orders just came in at 0.2% month over month against a consensus of 0.9%. That is a clear miss. Headline orders 0.8% versus 1.6. VIX nudged up to 1886, up about a point pre-market. The central tension is this. Korea's semiconductor crash says systemic margin liquidation, but the VIX is still pricing a garden variety pullback. Only one of those can be right.
That's the show. Let's get straight into it. The headline, screamers say China chip threat, but that's the excuse. The real story is a Korean retail margin liquidation cascade, KOS, PI minus 10.84, Nikkei minus 3.95, SK Hynix down 14.65%. The transmission mechanism is what matters. 65% of alternative trading system revenue in Asia comes out of Korea. These are not institutional dark pools. They're leveraged retail traders. 20% of REX shares assets under management trace right back to Korean investors holding leveraged single-stock ETFs on names like Tesla and Nvidia. When those blow, forced selling feeds itself. One margin call triggers the next. It's a plumbing failure, not a trade war.
And that plumbing failure connects directly to the U.S. semi-complex. The structural vulnerability is NVIDIA's circular financing chain. The same Korean retail crowd that was leveraged long SK Hynix and Samsung had exposure through NVIDIA's suppliers. As their positions get liquidated, it spills into U.S. chips. Look at the divergence. The IGV software ETF is essentially flat on the day, while the SMH semiconductor ETF is falling through support. Money is not rotating within tech, it is leaving tech altogether. That's a broad risk-off signal, not a sector reshuffle.
Exactly. When semis are getting annihilated and software can't catch a single bid, the whole artificial intelligence trade is unwinding. The carnage is concentrated right now, but if the KOSP opens down again tonight, we get round 2 of forced selling straight into North American names at the open tomorrow. That's the clock we're watching. Now, on top of the chip plumbing failure, we have the Fed trap. And the durable goods data just handed us a curveball.
Grind. Core durable goods missed badly. 0.2 versus consensus 0.9. Headline also weak. In a vacuum, that gives cover to hold rates tomorrow. But Citadel is still putting 40% odds on a surprise hike. Trump is publicly backing Chairman Warsh while labeling other board members bad intentions. Kalshi markets are showing over 50% probability that Warsh says something shocking at the press conference. This is not a normal Federal Open Market Committee preview. This is an active White House versus board conflict, and the chairman is caught in the middle.
So, what would a surprise 25 basis point hike actually do?
The 2-year yield would spike 15 to 20 basis points instantly. The yield curve flattens hard, the dollar rips higher. Every rate-sensitive sector, small caps, regional banks, home builders, gets clubbed. But the bigger second-order effect is global leverage. The Korean liquidation story connects directly here. A surprise hike tightens dollar liquidity worldwide overnight, triggering margin calls in emerging markets on top of the ones already happening in Seoul. That is the contagion path nobody is pricing right now because the base case is still a hold. The durable goods miss makes that tail event even more destabilizing. Weak economy plus surprise tightening equals recession, fears that cascade fast.
And the VIX at 1886 does not believe a word of it. If there were genuinely a 40% chance of a shock hike tomorrow, the fear gauge would be north of 25, not lounging in the high teens. Either the market is complacent or Citadel is early. I lean complacent. We have had a year of the Fed is done hiking consensus that keeps getting tested. The asymmetry here is absurd. If Warsh holds, VIX drops to 16 and nobody cares. If he hikes, VIX rips to 30 and everything breaks. The trade is to own volatility, not to guess direction.
That is the highest probability setup. Buying VIX calls or a straddle into the decision gives you a hugely lopsided payoff. The durable goods miss actually makes the shock more painful because the data says hold. So a hike would be a pure political statement that surprises the entire market.
All right, let's shift to oil real quick. Oil down 2.5% to $80.55 on hopes of a ceasefire. But today, Trump openly threatened to restart bombing if the talks stall. Iran still claims it controls the Strait of Hormuz. The Strategic Petroleum Reserve is at its lowest since 1983. The market is pricing the peace narrative, not the supply reality.
And here's where our track record demands I speak up. About a third of our misses over the past year were long oil risk calls. Times we called a new floor, only to watch crude grind lower. So I have to voice the de-escalation countercase. This ceasefire could hold. Iran might actually back off, and the administration could start rebuilding the SPR. If progress on the peace track continues, oil could slide to 75, and your stop would get run. What is different this time from your June peace deal loss?
Totally fair. In June, the peace deal had legs, real diplomatic momentum, so when the thesis broke, I closed for a loss. This time, Trump is threatening to resume bombing today. The structural supply risk is unchanged. The ceasefire is a pause, not a resolution. My gut call account is long. The energy sector, ETF, entry 56.94, now 58.36, stop at 54.30. That stop is the line. If the ceasefire solidifies and we see no escalation for a week, I'm out. Right now, the market is early, not wrong. There's a difference between a broken thesis and an impatient tape, and that lesson cost me real money to learn.
Good discipline. My gut book holds BYD, entry 87.15, now 89.29, stop at 82. The China EV demand recovery thesis is still intact, despite the Pentagon label noise. Both our personal positions survive because the theses are intact, not because the tape is friendly. Meanwhile, both our algorithms are heavy cash. My Wave Trader algo is sitting 48% cash with only Apple, Bank of America, and Insight. No trend to ride. That is the market telling you it is statistically broken.
Yep, the TFT algo is also nearly half cash. Same message. When both systems go quiet, the trend is not your friend.
Quick earnings check before we move on.
Actually, we have big earnings this week. Coca-Cola, Boeing, Visa today, then Microsoft and Meta on Wednesday. Everyone is waiting on macro, but earnings matter this week. Moving on.
Let's hit the rest of the economic calendar. Wednesday, we get the Bank of Japan core CPI, prior 2.7%. A hot number could push the yen stronger and add a new layer to the dollar-yen unwind risk. Then, U.S. consumer confidence, consensus 92.4. Thursday's the Fed decision, full stop, that's the week. Friday brings German GDP, consensus 0.1%, plus a wave of regional German inflation prints, and Eurozone GDP and consumer confidence. The entire macro world pivots on Thursday afternoon. Sector rotation over the past week paints the same exodus story. Leaders: Industrials XLI, up 2.85%. Materials XLB, up 2.72%. Healthcare XLV, up 2.61%. Laggards: Technology. The tech sector down 0.8%. Communication Services X, LC down 2.83%. Consumer Discretionary XLY, down 3.29%. Money is fleeing growth and tech into value cyclicals and defensives. Healthcare leading is a classic late cycle risk-off signal.
It matches the semi-software breakdown. When the defense is leading and tech is bleeding, risk appetite is draining fast. That is not a dip to buy. That's a rotation to safety you respect.
International overnight confirms the weird dichotomy. Asia was a bloodbath. Nikkei minus 3.95, KOSP I minus 10.84 with circuit breakers. Shanghai flat, Hang Seng actually up 0.41. Europe, meanwhile, is selectively uncorrelated. DAX up 0.42, FTSE up 0.35, Eurostox up 0.27. The dollar yen only moved 0.07%, and the dollar index is flat. This is not a classic yen carry unwind. It is a local Korean leverage accident with global contagion potential. The fact that Europe is calm while Asia burned is the same story as the VIX. The full tale is not yet priced.
If U.S. futures continue to ignore the KOSP, circuit breakers, the repricing, when it comes, will be violent. That is why owning volume is the trade of the week. Alright, let's land on portfolio hot news. The auto-detected hot theme is global leverage, unwind, and supply shock theses. The drivers: Korean retail margin cascade triggering forced selling, which spills into Nvidia circular financing, which cracks semis, and then tomorrow's Fed risk compounds everything globally. The bull case is simple. Durable goods miss, Fed holds. Wash sounds dovish, risk assets squeeze, and oil bounces on supply reality. The bear case is the shock. Wash hikes, the dollar rips, emerging market margin calls multiply, and are the energy sector, ETF, and BYD positions get hit alongside everything else.
Second order effects. The VIX mispricing is an opportunity right now. If Warsh holds, the volume crush is modest. If he hikes, the volume spike is violent. Option sellers could get steamrolled, and the unwind of vol selling strategies would amplify the equity down move. That is not priced into 1886. Our book reflects this caution. The wave trader algo is 48% cash. The TFT algo is nearly half cash. The market is statistically broken, and the systems know it. My gut book is long BYD with a stop at 82, and Wildcard's gut book is long the energy sector ETF with a stop at 54.30. Both positions are held because the theses are alive, not because the tape is friendly. If contagion spreads, those stops will be honored. Until then, conviction over noise.
Here's what we're watching tomorrow. Number 1. VIX above 20. If the fear gauge finally wakes up, positioning changes rapidly. Number 2. The KOSPI's next support. If circuit breakers fail again tonight, the contagion clock accelerates. Number 3. The 2-year yield after today's durable goods. If it rises despite the miss, the hike camp is gaining momentum. Number 4. Warsh's pre-decision body language. Any leak, any eyebrow raise, moves markets in a split second. Cash is a position. The rotation data screams value over growth. The VIX asymmetry is the trade. Stay nimble, honor your stops, and don't let the noise shake you out of a plan. Trading family, we'll see you back here tomorrow. Peace.